Hi, welcome back to another session on risk. You're probably saying, another session on risk? We've talked a lot about risk. You're right. But this is about a particular aspect of risk, catastrophe risk. Put simply, what do you do as a business or an investor when you're facing Armageddon? It's a pretty long lead-in, but let's get started. I often write about, I value companies, I write about risk, and I do get emails from readers saying, can you value a company? Sometimes I do try to value the companies as suggested. Most of the times I don't have enough bandwidth to value as many companies as would be needed. But a few weeks ago, I got an email from somebody in Iceland saying, could you take a look at a business called Blue Lagoon? It's an Icelandic company. So I took a look. It's a spa. It's a well-regarded spa, profitable. It's been around a while, but it's now facing an existential threat. A volcano is erupting, and that volcanic eruption threatens to put this business out of existence. And he said, how do you value business when your very existence is under threat? This is not about margins being off or revenue growth being wrong. It's the existence of the company. A few days later after that, I was reading about a company called 23andMe. It's a genetic testing company that you can send saliva to. And not only can they give you a genetic background, but they can also give you information about your health. Turns out that a hacker has hacked the site and was able to access millions of customers' genetic information. A threat to the company's existence, because you send your saliva to a company expecting it to be something between you and the company, and now the hacker knows and the rest of the world might. And more generally, and this is the biggest issues, for the last 20 years, the climate change has been the existential crisis we've talked about. The crisis that we argue will take over the world. We need to do something about it. And there's one sector that's been at the heart of this argument, and that's fossil fuels. And I want to talk about what are investors doing to price in what they see as changes coming because of climate change. Are they doing it? Are they missing it? So let's talk about all of these in the context of catastrophe risk. Now, in an earlier session on risk, I talked about the different groupings you could put risk into. Economic risk that comes from underlying economics, and estimation risk, which you can reduce by collecting data. I talked about micro risk, which affects the company, and macro risk, which comes from interest rates and inflation in the economy. And then I talked about discrete and continuous risk. Continuous risk being risk that you're exposed to every moment of every day. Exchange rates changing if you're a US company with European operations. And discrete risk, which is risk that doesn't show up very often, but when it does, it's much more significant. A related categorization of risk is risk that you can call incremental risk that is small enough that you live through it. Doesn't mean it doesn't have a material impact, but it doesn't put your existence at threat. And catastrophic risk, which can either put the company's survival at risk or change its trajectory dramatically, make it a very different company. So I want to focus in particular on catastrophic risk. Let's start by looking at where catastrophic risk comes from. The first, and if you remember the Iceland story, is acts of God, nature. And let's face it, this is the oldest source of risk known to man. There's a reason why the oldest risk management system is getting down on your knees and praying to God. Acts of God, whether it's hurricanes or earthquakes. I happen to live 2 blocks from the ocean in California on a major earthquake. And there is a chance that there could be catastrophic risk. I hope there isn't, but clearly your source of risk can come from nature. They can come from man-made events. We have wars, we have terrorist attacks. In addition, men often take actions at individual companies and can expose the company to catastrophic risk. Finally, and you could argue that this is just a subset of man-made risk, is regulatory or tax law changing can put a company's business model at risk. So it can be nature, it can be man, it could be regulations or laws. The second way to categorize catastrophic risk is it risk that affects one or a few companies, or is it risk that affects most or all companies? Let's take a few examples. The 23andMe risk, where some hacker got into your computer and got the information of your customers, is clearly specific to one company. The volcanic eruption in Iceland affects not just one company, but a few companies in Iceland that happen to be in the path of the lava. But we go back to 2020, and if you remember the pandemic risk, it affected almost every company in the market. So clearly the locus of damage can be A few companies, one company, a few companies, or most or all companies. And we'll talk about why that matters. And the third way to think about catastrophic risk is in terms of likelihood. Luckily for us, most catastrophic risk has low probability. So that's why we tend to push it to the back burner, and many of the solutions to catastrophic risk are built on the presumption that even though its consequences are significant, it happens so rarely. But those catastrophic risks can sometimes become imminent. The small probabilities can become big ones. Pre-2020, people talked about the risk of a pandemic, but we didn't think much about it. We said we've advanced enough as humanity that we have the medicine and the technology to stop pandemics. And then we discovered otherwise. So sometimes catastrophic risk you kind of put on the back burner until you cannot do it anymore. So with that lead in, let's talk a little bit about the value and pricing implications of catastrophic risk. And let's call it cat risk for the moment, because I don't want to keep saying catastrophic. Now, the reason I draw the distinction between value and pricing is, if you've heard me talk about value and price, I believe they're very different processes. Value is driven by cash flows, growth, and risk. They reflect business quality. Price is driven by demand and supply. And while they might reflect business quality, they're also reflectors of mood and momentum. I'm going to look first at the value implications of cat risk. How do you show catastrophic risk when valuing a company? And then we'll talk about what the market does to price in catastrophic risk. So I'm going to start this discussion of how catastrophic risk affects value by going back to what I call the IT proposition. When I start my valuation class, I put up the equation that drives intrinsic value. It's that present value equation. The value of an asset is the present value of the expected cash flows over the life of the asset. That's the equation. So everything in the class is about getting expected cash flows and risk adjusting the discount rates. Here's what the proposition says. If it's going to affect value, it has to either show up in the expected cash flows or it has to affect risk. What's it? You name it. A few months ago, I valued intangibles in Birkenstock, including the Barbie buzz and the brand name and the great management. Basically, I traced out the effects that these intangibles have on cash flows and risk. A couple of years ago, I was a little harsh, maybe a lot harsh about ESG. And one of the reasons I was so harsh about ESG was the claim I heard repeatedly before 2020 that being good was good for value, that ESG, getting a high score would increase value. And my response was where? And when you put it through, you realized how empty the concept was. So to assess catastrophic risk, I'm going to look at where it might show up in this equation. And the answer is pretty much everywhere. It can show up, if you think about the risk of a catastrophe, it can show up in your expected cash flows. It can change your operating metrics, margins, so it can affect your expected cash flows. It can affect your risk, and through the cost of equity, the cost of debt, especially if the risk you're looking at, the catastrophic risk, is risk that affects many or most firms. In some cases, catastrophic risk can show up in your cash flows directly if you can buy insurance against that risk as a cost that reduces profits and cash flows. And finally, catastrophic risk can affect your likelihood of surviving as a company. It can show up through failure risk as a company. When you fail as a company, there is no going concern. It affects value. So when you look at this, you're saying it shows up everywhere. How do I know which approach to use for a specific catastrophic risk? So here's what I'm going to try to do. I'm going to look at 5 types of catastrophic risk and talk about how they show up in intrinsic value, the pluses and minuses, and perhaps a couple of applications. So to understand this, I'm going to go back and deconstruct cat risk and ask 2 questions about cat risk. One is it insurable? The answer is yes. Then I think our life got a little simpler, because you can then estimate a cost of insuring, bring it into your cash flows, reduce your cash flows, and affect value through that. If it's not insurable, then I'm going to ask you a follow-up question. Does this risk expose the firm to a chance of failure? Is it existential risk? If the answer is yes, then I'm going to value the firm as if there's no catastrophic risk. I know, it sounds insane, but I'm going to value the company as if there's no catastrophic risk. And then when I'm done, I'm going to estimate a likelihood of failure. And it can be a big number. And what my assets will be worth in the event of failure. And my expected value will be a weighted average. My going concern value from my DCF times the likelihood I will survive, plus the failure value times failure risk. That is if there's a chance of failure. Sometimes catastrophic risk can just change your trajectory, make you a much smaller, less valuable business, but not put you out of business. There, I'm going to do two valuations. The first valuation, I'm going to value the firm as if there were no cat risk, very similar to the failure phenomenon. But the second valuation I will value the firm again with the catastrophic risk in place. Much lower value, attach probabilities to the two scenarios, take an expected value. So those are the cash flow, failure risk, and in some cases the cost of debt effects. Now the other question I'm going to ask you about cat risk is, does it affect one or many firms? And if it affects many firms, does it affect a sector or the entire market? And here's why I care. If catastrophic risk is company specific, the 23andMe is a classic example. Investors who are diversified will tend to underplay that risk. They might bring it into the expected cash flows, but it's not going to affect the discount rate. If catastrophic risk is sector-wide, something that an entire sector is affected by. Remember after COVID, when the economy shut down, hotels and airlines were particularly affected. It is going to affect the cost of equity of these companies because in effect, these sectors have higher betas and higher costs of equity. If you have something that affects the entire market, a catastrophic risk, then I'm going to argue that you've increased the equity risk premium and through it the cost of equity of every company. So you can already see, depending on the type of business catastrophic risk you're talking about, the solution varies across companies. So let's start with the easiest catastrophic risk to work with. If it's insurable, and let's face it, insurance companies have had the longest history with catastrophic risk. They understand it, they lived with it. In fact, their business model is built on it. But if you have a catastrophic risk that is insurable, and you have a cost, you don't even have to do the insurance. All you need is an estimate of the cost. The intrinsic value effect is easy to estimate. You put in that insurance cost into your costs, it lowers your income and your cash flows, and then you value the company. It lowers your value as a company, but it's through the cost. The plus is it's simple and it's specific because this insurance premium goes with this catastrophic risk. In a sense, you assume that insurance companies know what they're doing. What are the minuses? There are lots of risks that you cannot insure against, either because there's no history, the actuaries can't attach a probability, or because it's imminent. If Blue Lagoon, that Icelandic spa, tried to go out and get insurance now against a volcanic eruption, I don't think they're going to be able to get it. So lots of cases, it's not insurable. Or you might have insurance, but the insurance is not complete. Let me give you an example. You could be a California company with a factory at the base of a forest, and because of wildfires, you worry about catastrophic risk. And you might buy insurance against wildfires, but the insurance covers the cost of the factory. It doesn't cover the present value, the cash flows that come from the factory. So from that perspective, insurance may not be complete. Now, we actually let insurance bail us out in a lot of catastrophic risks. I mean, if you think about the number of small Florida and California companies that get valued and how we don't factor in catastrophic risk, it's because we make the assumption that insurance is complete. That might or might not be true, but when businesses are insured, you can effectively work with existing intrinsic value models and bring them in. It's interesting though, if you value a California business, you might want to ask the business whether they're fully insured rather than just assume it. Because if they're not, then you have to estimate the cost of insurance, bring it into their earnings and cash flows, lower those numbers and revalue the company. Second grouping of risk, you have an uninsurable risk, but it'll leave you as a going concern even if it manifests and it's company specific. As I said, do two valuations. One, value the company without the catastrophe. So basically, it'll be a steady state, going concern value, no catastrophe. And then value the company again with the catastrophe. Different cash flows, much lower cash flows, much lower value. Attach probabilities to the two scenarios. It's basically scenario analysis with two broad scenarios. The plus is by separating the catastrophic risk scenario from the going concern, from the regular non-catastrophic risk scenario, you make your life easier. I've seen analysts try to struggle to come up with a discount rate that reflects both catastrophes and non-catastrophe scenarios. It's tough to do. This way you keep the two scenarios separate, you do two valuations. You still have to attach probabilities to the two scenarios, but I think it's more tractable. The minus is you're going to struggle estimating the probability of a catastrophe. Now, why? Because many of these catastrophes require skills that you and I don't have. I mean, if you have a hurricane or an earthquake, you need a seismologist, a meteorologist. Now, I don't know who the expert who will tell you something about volcanoes is. You need expert help to get those probabilities. Luckily, we live in a world that you can reach out to get that help. And you still have to assess what will happen to the value of your company if that catastrophe occurs. I've used this approach on multiple scenarios. For instance, a few months ago, I wrote about the value of key people in a business. The CEO, the best salesman, a scientist in a pharmaceutical company who's been turning out every patent. And I said to value that key person, here's what you need to do. You need to value the company with the key person in place. Then you need to value the company without that key person, if I sound familiar, and take the difference. Second example would be a company, a small company that has 3 contracts, but one of the contracts accounts for 50% of its revenues, and it's with Walmart. You can value the company as if nothing will happen, but this company is 1 contract loss away from shrinking in half. So you might want to do 2 valuations here and attach a probability at least that Walmart might walk away as a customer. Finally, if you have a company that's regulated and you're worrying about regulatory changes, you might want to value the company twice, once with the regulatory change and once without, and take an expected value. Lots of potential applications. Now let's take a third possibility, very closely related to the previous one. You have an uninsurable catastrophic risk, but this risk can cause you to fail. It's an existential risk and it's company specific, like the previous one. It's very similar to what we did in the previous scenario, but to compute the intrinsic value, you have to compute 2 values, just like in the previous scenario. The first one is the value without catastrophe. And the second one is a failure value. If you fail, what will you get for your assets? It might be nothing, it might be half of book value, but you have to estimate 2 numbers and then take the expected value. So as with the previous approach, this approach requires you to come up with 2 different values. And by separating failure from going concern, it again saves you an immense amount of heartache. I've seen people try to estimate the cost of debt for companies that potentially might fail. And they keep hiking up the cost of capital, hoping that using a higher discount rate will take care of the problem. But unfortunately, failure is a truncation risk. Discount rates were blunt instruments, never meant for that. So as a plus, this is going to make your life easier if you view these as 2 separate valuations. Minus, you still have to attach a probability to that to the catastrophe. You need the help of experts on the space and take advantage of them. And then you have to estimate what you will get in failure. What would you get if you liquidate those assets in the event of a catastrophic risk? So the pluses and minuses look very similar to the previous scenario. In terms of applications, this is the approach I use to value highly leveraged cyclical companies. I call them trouble companies. Lots of debt, potentially money making could become money losing. And I think trying to adjust the cost of capital for these companies for the possibility that they will not make it is a fruitless exercise. So I value them twice. Once with the going concern assumption where nothing goes wrong, and then again with the failure assumption and take an expected value. The fourth and the fifth scenario possibilities in terms of uninsurable risk are look very much like the previous 2, but the only difference is instead of being company specific, they cut across the entire sector or the market. So the one big difference then is while you do the 2 valuations just like you did in the second and the third examples, you now might have to adjust your cost of capital. In what way? If you have a risk that affects an entire sector, and I'll give you an example, after 2008, banks became riskier as a business. You adjust the betas for the sector upwards, reflect the catastrophic risk possibility, which increases your cost of equity. If you have a risk that cuts across the market, your equity risk premium should capture it. Now, the way we compute equity risk premiums and betas, unfortunately, does not allow for this. So that's part of the reason I've been so pushy about asking people to try an implied equity risk premium. You might not like my assumptions, but a forward-looking dynamic premium, which is what I get with an implied premium, is more likely to capture those changes in equity risk premium during a crisis. If you get a chance, take a look at my writings during the COVID year, where I estimated the equity risk premium every day for the whole year. And you can see how equity risk premiums adjusted up first and then down again towards the end of the year. And I do my industry average betas and update them again every year, again, hoping to catch changes in sectors through those betas. Now, when you look at the pricing side, things are a little more, one of the problems with valuation is we're assuming that people are rational in the face of catastrophes or potential catastrophes. And we know we're not. In fact, no one is. I'll give you the two common responses to the likelihood of a catastrophe. The one is denial. Okay? I can attest to that. As I said, I live on an earthquake fault, and I don't think about earthquakes all of the time, because if I did, I'd drive myself crazy. So denial comes easily because that's the only way you can live day to day. The second is panic. If in fact I noticed tremors right now and the earth started shaking badly, I'd be out of here. Who cares about a YouTube video when you can't make it out of the house? Denial and panic are human responses, and market pricing reflects it. I think what markets tend to do, and this is a general statement, is they tend to underestimate the risk of what a catastrophe will do to value and pricing when the chance of the catastrophe is low. So they underprice it. And then when the catastrophe becomes imminent, they overprice it. So you tend to see reactions in both directions. So I'll give you a few examples. If you remember again, let's go back to COVID. The global economy shut down. Everybody was affected, but some were affected more than others. So towards the end of March, it was the height of the fear factor. March 23rd was the absolute worst day. That was the bottom of the market. I looked at the sectors that had done the worst and the best between February 14th and March 27th. That was the worst period. And you can see as you go down the list of the worst performing sectors, you see hotels, air transport, the kinds of businesses that were hurt the most by COVID and the economy shutting down. The best performing sectors are the sectors where people needed them in spite of the fact that the economy had shut down. So you tend to see when you have crises, markets react. Did they overreact? In hindsight, it looked like they did, but who really can tell? In terms of individual companies that have catastrophes, again, when the catastrophe is low and in the distant future, people seem to underestimate them. PG&E has always had wiring in the middle of forests in California. Nobody thought about it for a moment until you had some wildfires towards the end of the last decade, and PG&E lost almost half its value, got pushed into bankruptcy precisely because of those fires. Young pharmaceutical companies, where we often overestimate the payoff from a blockbuster drug until we get a bad trial and everything falls apart. So again, you get that overreaction and underreaction depending on where you are in terms of the catastrophic risk. There's one final thing I want to talk about, and this is fossil fuels. You go back 20 years, climate change was just starting to become a big issue scientists might have been talking about it for 40 years, but in the last 20 years, clearly it's taken center stage. And if you carry it through, clearly the villains in the climate change story are fossil fuel companies. So starting about 20 years ago, fossil fuel companies became the targets for a lot of pressure from people selling their shares, divesting their shares, trying to push their shares down, and also challenges to their business models. In fact, many advocates for action against climate change argued that fossil fuel companies' days were numbered, because what would happen is there'd be less demand for fossil fuels because climate change was such a big problem. That less demand would translate into less oil sold, lower earnings, less cash flow, perhaps even a truncation of corporate lives. That fossil fuel companies were looking at an end game that did not look like it would be an attractive end game for any company. So I decided to take a look at fossil fuel companies over the last 20 years to see if that has played out. So on the left, you see a graph of market caps of fossil fuel companies. That's the black line against, and basically you got the oil price. The oil price on the black line, and in the same graph, I've got what the collective market value of all fossil fuel companies. Take a look, right? First thing you notice is the biggest driver of market cap on fossil fuel companies, not surprisingly, is the oil price. But take a look at this one time period, 2008 through 12, where even though oil prices peaked, oil market caps did not go up. Think of that as peak villain status for fossil fuel companies. They were right they were in the target for every critic out there. They were cowed. They basically, and investors seem to go along. Investors seem to be buying into the argument that the end game was here for fossil fuel companies. But then you look to the right and I have the pricing metrics, EV to EBITDA, EV to sales for oil companies. And after that dip in 2011, 12, 13, you see that those pricing metrics have recovered. In fact, if you look at the last 2 or 3 years in particular, fossil fuel companies seem to have rediscovered their mojo. In what sense? The fossil fuel stock prices are up, the market caps are up. But fossil fuel companies seem to also have been much more willing to come out and say, we're in the fossil fuel business, and actually we're going to acquire other fossil fuel companies. Exxon Mobil, Royal Dutch, BP are all announcing fossil fuel plants. You're saying, what happened? Well, maybe the reason this is happening is I think the climate change punch is fading, because the reality is what people expected would happen is over time we would get less of our energy from fossil fuel because fewer people used it. And it turns out that that sales pitch hasn't quite worked, because when you look at the evidence on where we get our energy, it is actually pretty depressing. This is actually from 1971 through 2021, and this is something I used in my impact investing piece as well. I break down where we get our energy into fossil fuels, which have always been the dominant source, the good source of energy, wind, solar, and power, and biomass and nuclear. And you can see that if I compare 2021 to 1992, almost nothing has changed. We get about the same percentage of our energy 30 years after all of this climate change pressure as we did before. Now, I'm not suggesting this is something to celebrate, but clearly fossil fuel companies are looking at this and saying, you need us. And who can tell them they're wrong? We clearly need fossil fuel companies because we like our power, we like consuming power, and fossil fuel gives us the power. That's entirely possible that as investors, because we have this history of pricing, we're underestimating the impact of climate change on fossil fuel companies. But why pick just on those investors? A person who buys a $500 million building in Manhattan, shouldn't that person be wondering about what will happen if climate change plays out and Manhattan goes underwater? Forget about that person. As I said, own a house on both an earthquake fault and 2 blocks from the ocean. Should I be paying? What will happen to the value of my house if a catastrophe unfolds? I think it's easy to point fingers at others and tell them that they're not being rational. The truth is, it's difficult for human beings to deal with Armageddon scenarios where everything, and maybe there's a reason for that, because if an Armageddon scenario plays out, a huge meteor hits the earth gets too hot for most human beings to exist, a nuclear war. You know why you don't worry about value effects? Because if those things happen, survival is going to be the first. It doesn't matter how much money you have in your portfolio. I don't even know where you'd spend your money. So maybe the reason we ignore those scenarios is in those scenarios, your investment doesn't matter anyway. So maybe investors are not being so rational in ruling those scenarios out when they value companies. But I think we can still take the issue up with them. I hope you found the session useful, and thank you very much for listening.